Hello everyone, good morning. Today we are going to basically be discussing on a different topic, a new topic which basically I believe all of you would need to be able to get to understand the market better, especially for newbies. So now, some persons when they look at this particular thing, I'll call it a thing, and they look at this whole interface, they are confused. They don't know what this interface is trying to explain. They don't know what the interface is. They don't know the interpretation of this interface. Now, for a start, this interface is basically what we call a market chart. Are you with me? So this interface is what we call a market chart. Now, what is constituted in a market chart are basically different things. Now, in a market chart, you can find out that we have what we call the name of the pair that is being traded. So, like this one, we have British pound, Japanese yen, which is basically in short form GBP JPY. So now, you see here it says sell, you see here it says buy. So it's basically you deciding whether you want to buy the pair at a particular point in time or you want to sell it at a particular point in time. Now, at this interface here, we have what we call the time frames. So now, you can see these are the time frames we selected, but now I want to show you the time frames from the top to bottom. So basically, these are ticks. You see ticks. These are the ticks. You see these are seconds, down to 45 seconds, 15 seconds, and all of that. We have the minute time frame, which are the 1 minute, 15 minutes, all of that, 45 minutes, and so on. We have the 1 hour. So these are the hour time frames, down to 4 hours. We have the daily, which is the daily time frame, weekly time frame, monthly, 6 months, 12 months, and so on. Then we have the range. So all these are different time frames we have, which I would explain what they are shortly. So now, at this area, we have the different pairs being listed, you understand, whether currency pairs or and so on. So we have the different pairs being listed at this angle. Now, at the bottom here, we have the times, the years basically. So we have 2003, 2005, 2007, 2009, 2011. So you see these are the different times basically. The in terms of years are being listed at the bottom. Now, if you go a little bit deeper, you get to see that we even get to see the times in terms of the day, in terms of the months. Now, by the side here, all these are basically tools used to trade. So you can see we have the cross, dot, arrow, the demonstration tool, which is fine, magic to eraser. I'll come here. You see a list of the different tools we have. You get. So when you keep scrolling down, you see the different tools you get. You see the different tools. So you see we have a lot of tools. You see these ones are selected yellow are the ones you can see here. So those are the tools I've picked out, which I feel familiar with and I feel okay to use them. You see this brush tool, the rectangular tool. You can see them here. This is the rectangular tool. This is the brush tool. So you see this one, text. I selected text. That is what enables me to be able to write my text here. And we also have this one, which is the different emojis basically. Then we have the next one, the ruler. We have all of these different tools. They just help you to be able to analyze the market and pick better information off of the chart. Now, let's come down to how a market chart is being formed. Now, a market chart is being formed off from the current price. Now, we have what we call market current price. This is, okay, good. So I would point this arrow here. So basically, if you look clearly at the arrow, you see that I have this arrow pointed at this current number, which is 210.976. Now, this price is the current price value of market, you understand, of the market, which is 210.976. Now, this current price of market basically is something that creates all these charts, which we call candlesticks. So now, currently we are on the monthly time frame. So on the monthly time frame simply gives us one particular meaning, which says all of these candlesticks you see here are being formed during each month. So if we should go down, we have this. So we have this is a monthly candlestick, this is another month, so each of these different months are candlestick formed during a particular month. I don't know if you understand what I'm saying. So all these are different candlesticks formed during particular months, you get. So now, going down a little bit to explain how are these candlesticks being formed. Now, during a particular month, you have price opening from a point to another point, which is during a particular month we have price opening from, let's say, point A and it closes at point B. Now we are tagging point A where price opened to be the bottom of the price, which is let's say, okay, let me go a little bit stiffer to give a better explanation so you guys can understand me very well. So I would pick this, fine. So now let's say, for instance, we have price moving from point 160 to point 170. So let me use the line graph. So this is the line graph at point 170 and this is the line graph at point 160. So now let's take, for instance, price started during the month at price 160. So that way you have this here at price 160. Okay, let me delete this. I'll make it a little bit short so the message will be clear. So you have price starting at price 160. So when it opens at price 160, you will see price, it does something most times. It would most times drop to the downside. Let's say it will drop to the downside. Let's say it dropped to price 155. You get. Now when it drops to price 155 and pushes back up, it creates what we call a market wick. Now it pushes up to the upside, which is price 170. Now when it gets to this price 170, most of the time it will surpass it. It will surpass it to the upside and then come back again to that same price 170. So now this surpassing, this point at which we push to the upside to create to this, maybe let's say it pushed to price 177. Now it's basically called the wick being created. Now when it comes back, you have this area here, which is so you have this area here, which is the body. So this body basically is where we can consider price closing. So now when with this formula, you see that the full candlestick has been formed, and I explained how the candlestick was formed. Basically, we have the wick, we have the point where price opened, we have the point where price closed, and we have the highest point wick price got to, which is the wick. Now this basically is considered as a bullish candlestick. Why? Because Bullish candlestick gives us a representation saying bullish candlestick opens from the bottom and closes at the top, leaving wicks behind. That is basically a bullish candlestick. Now, for a bearish candlestick, it's different, which is a bearish candlestick opens at the top and closes at the bottom, leaving wicks behind. Leaving wicks behind. So basically, this is a bearish candlestick. So if I want to go a little bit with diagram, I'll just stick in it so that you can see that it's a little bit different from this one. So bearish candlesticks, it opens at the top and closes at the bottom, leaving wicks behind. While for a bullish candlestick opens at the bottom and closes at the top, leaving wicks behind. You understand? So basically, that is one of the major things you need to understand about candlesticks. Now, there are only two candlesticks. We have two types of candlesticks. We have the bullish candlesticks and the bearish candlesticks. Now, a bullish candlestick on this chart representation basically is the green candlesticks. So the green candlesticks, you can see the green candlesticks, they are all bullish candlesticks because they opened at the top, at the bottom and closed at the top basically. So all these green candlesticks, they opened at the bottom, like they opened here and closed here. They opened here and closed here. So basically, that is how to identify a bullish candlestick. Now for a bearish candlestick for instance here, it opened at the top and closed at the bottom. A bearish candlestick like this one opened at the top and closed at the bottom. A bearish candlestick like this, it opened at the top and closed at the bottom, leaving wicks behind. So you see for this again, a bearish candlestick, it opens at the top and closes at the bottom, leaving wicks behind. So basically, this is how to be able to understand a bearish candlestick basically and market charts. So now this is very important because this information will be able to help you to understand what you are doing at the market. You understand? It will help you understand what you are doing at the market. Now, I want to go a little bit deeper in the analysis, which is I'll clear all of this I've dropped on the screen. Now, how do we understand the chart differences in terms of time frame? Now we are on the monthly time frame. A monthly time frame simply signifies that all of these candlesticks on this chart, they open and close during the month. So they are all monthly candlesticks. Now, when we go to the weekly, it simply tells us that all of these candlesticks on the weekly time frame, they are all weekly candlesticks. So each of these candlesticks open and close after every week. Each of the candlesticks on this chart, they open and close after every week. So that is one thing you must understand when it comes to weekly candlesticks. Now, when we go to the daily time frame, it simply means one thing too. It simply means that all of the candlesticks on this daily time frame, they open and close after every day. You understand? So I told you a candlestick opens from the bottom and closes at the top. So if it opens at the bottom or at the top, it will close at the end of the day, signifying whether it's a bullish candlestick or it's a bearish candlestick. Now, same as 4 hours, same as 1 hour, let's go to the 1 hour. So for 1 hour, you can see here, it simply signifies that each of these 1 hour candlestick, they open and close after every 1 hour basically. So after every 1 hour, you find out that a candlestick will open and close. Now we can go down to 5 minutes time frame. For the 5 minutes time frame, you can see the candlesticks may look small, but it's just the same candlestick, just that it is a different time frame. So what can you see here? The 5 minutes candlestick, they open and close after every 5 minutes. So each of these candlesticks will open and close after every 5 minutes. So at a new 5 minutes, a new 5 minutes candlestick will open. At a new 5 minutes, a new 5 minutes candlestick will open. So basically, this is like a this is like a well